to the Professional Investment Podcast. I'm Charlotte Moore, award-winning journalist and co-founder of Moore Squared Communications. Each episode we welcome a guest to the show to share their news story of the week, and I'm delighted to welcome Paul Todd, Chief Operating Officer for Nest Invest, to the show. Welcome, Paul.
Thanks, Charlotte. It's great to be on the show.
Lovely to have you. Do tell us, what is your news story of the week?
My news story of the week is from Pensions Expert, and it's about a debate that took place during the Pensions Bill third reading, and it was discussing the role of fiduciary duty and how that might be clarified or expanded going forward.
Okay, and do tell us, why do you think this is important? Why did you make it your news story of the week?
I think it's really interesting. There's been lots of discussion and debate about fiduciary duty and what trustees can and can't do over many years. There was a big review by the Law Commission trying to bring some clarity to fiduciary duty. And it's an area that I think people have just found quite confusing. And I think it was sort of well overdue for further discussion. And I think particularly in light of modern approaches to investing in a world of kind of master trusts where millions of people are in default strategies, giving trustees as much clarity on what they can and can't do is really, really helpful. And I think this is kind of particularly timely when we're having discussions about how we should be investing, thinking about kind of broader issues such as climate change. But also there's a lot of debate at the moment about how we should be investing when thinking about investing in UK assets as well. So I think the debate was really, really interesting. I thought the amendment proposed by Liam Byrne was very thoughtful. I thought the response from government was welcoming, suggesting different ways this could be kind of taken forward. I think overall it will help trustees have a lot more confidence that actually their powers to invest are much broader than perhaps sometimes they've been led to believe. And provided they're thinking about key things, which are obviously about risk and return and what an investment's going to achieve, to have that kind of broader definition of also what the impact their investments have on their membership, on long-term issues such as climate, on issues about the UK economy and UK jobs. It's not saying that trustees have to take these into account, but it's a perfectly reasonable thing for them to think about when they're thinking about financial health or financial well-being. It's less of a narrow discussion about would this stock achieve an expected better return than one other stock. That's not really how investing works, and that's not how trustees should be thinking about this going forward.
So tell us, Paul. So tell us, how does investing work? Tell us how you think about that broader definition when you're investing, and let's take it from a big picture at the portfolio level before we dive into the different asset classes.
Yeah, so I mean, most people are kind of investing according to sort of modern portfolio theory, so thinking hard about diversification. And Nest, we're well diversified across the globe, across many different asset classes, and how one set of externalities affect all sorts of things to do with investment is increasingly a big part of our approach. A really, really obvious one is climate, and it's all very well if you can make an enormous amount of money out of one asset doing really, really well, but it may have severe impacts on kind of climate change and things, whereas all of your other assets are doing really, really poorly because of that one investment. So thinking about things in a broader portfolio way, thinking about broader externalities, I think will increasingly become a big part of the role of trustees.
Okay, so that's how you think about it as a portfolio level. Why don't we dive a bit deeper then and then think about how do you apply those different fiduciary duty concerns that are beyond risk and return, beyond what you're going to make from the asset, thinking about climate change or investing in the UK or any other concerns. Are there ones that apply in particular to particular asset classes, or do you amalgamate all of those concerns across all asset classes?
Yeah, so I think different approaches for different asset classes, thinking about kind of different durations, where we're investing in things over the long term, different risks and different externalities will have different impacts. I think increasingly as we get more into kind of private markets and we're investing in more illiquid ways, thinking about long-term risks, where there are asset classes or specific securities that we wouldn't be able to sell easily, thinking about what some of those kind of long-term risks, what their impact on them is becoming a much bigger part of the way we go about selection and when we go about thinking about different risks and opportunities. I think a really good example, we've invested quite heavily in wind farms off the coast of the UK. It's a great example of these are kind of good returns for our members. It's creating jobs in the UK. It's creating energy security. Hopefully it'll be lowering bills over the longer term. And this is part of the way that as we've got bigger and we have more kind of opportunities to be more sophisticated and invest in different ways, it kind of opens up our horizons for thinking about our investment portfolio in a slightly different way than we perhaps did when we only had a few million of assets under management.
Okay. And so you mentioned climate tilt there and you sort of touched on equities. Can you talk to us a bit more about how you think of climate and equity? So obviously, I mean, everything you're doing is investing for a very, very long term, ad infinity really and beyond, but at least for multiple decades. So how do you've talked about climate tilts and then equities, how do you do that? And how far do you take that? Because I know, for example, some people don't want to be too Paris aligned because they feel there's too much tracking error. How do you kind of manage those trade-offs?
Yeah, so our approach, particularly with developed equities, we are basically investing in the whole economy and we're investing kind of globally. We are not looking to divest from large chunks, large industrial sectors, but what we want to do is invest in those companies and those areas where there's a clear path for a transition to a low carbon economy. And having tilts rather than taking a kind of divestment approach allows us to kind of speed that transition approach up or slow it down depending on how we see progress going on things like multinational agreements. We're having long conversations about whether Paris alignment still makes sense. At the moment we do, and that's within our kind of climate change policy. But our aim is not to completely eradicate carbon from our portfolio, but make sure we're investing in those companies that have a clear transition plan towards what a low carbon economy is going to look like, and maybe front run the overall markets because we've got a longer time horizon.
Okay, and do you ever get concerned that maybe your tilt is going to push you out of whack with general market performance, or is that something you don't try to get too tied up on because you have the time?
Yeah, no, absolutely. So I think our tracking error from general indexes isn't that huge. But then when you think about what are the sort of most polluting industries, that's only one small part of our portfolio. So there will be some tracking error because we are trying to do something different. But this is because we're trying to look to the future. So it's very forward looking rather than backwards looking about who are the most polluting. It's who has the most kind of sensible strategy for dealing with a different world in which we'll be investing our members' contributions in the future.
And I think you've mentioned before, I mean, you have other concerns. It's not just climate change. There's been a lot in the press recently about UK pension funds sort of moving out of US equities, and we've seen sort of flows on a more general level move out of US equities over the past month or so because people are concerned about AI, at the very minimum, an AI bubble, and then if you're more cynical, whether the whole thing is overvalued. So how do you manage that kind of concentration risk? Some people don't worry so much about concentration risk. Is that something you actively think about?
Yeah, so we are. So our main kind of equity exposure, we have a lot of invested in kind of US tech companies. That's the way the index is constructed at the moment, and we're comfortable with that kind of index approach. But more recently, we've also started investing actively and having thematic portfolios as well as a balance to avoid that concentration risk that you're talking about. So I think we'd be wary of taking big bets against the US and big bets against US tech companies. But at the same time, I think we've had concerns for some time about how indexes have changed over the last sort of 10, 15 years, and a lot more concentration in the US and a lot more concentration in just certain areas. So it is something that we're carefully monitoring, and we have the techniques now in a way that we probably didn't sort of 5 years ago to be able to manage that if we think that becomes particularly acute.
So is that a case of sort of underweighting something and overweighting something else to sort of balance out the risk?
Yeah, it'd be more a case of putting more to active equity than the index equity that's most of our exposure. That would be a sort of efficient and sort of low cost way of dealing with that.
So when you talk about thematic, what's the theme?
So a number of themes. A lot of those are to do with kind of climate. Some are to do with kind of nature. There's elements of some of the social themes as well. So it's an active portfolio where we've asked the fund manager to invest in accordance with these themes. And one of the key things is to try and avoid some of the concentrations that we've seen in our index equity exposure.
Okay, great. Let's talk a bit about fixed income before we move into private assets, because I think fixed income is really interesting. And I mean, for a long time it was uninvestable, right? Because you got absolutely no returns. Now it's investable again. It's kind of fortuitous timing. Just as we get into the world of retirement income, fixed income becomes investable again. As you start to think about the members' journey beyond 65 and providing for them all the way to the point that they are no longer on this planet with us. How do you think about that broader term of fiduciary duty, about climate change, about productive assets, when it comes to fixed income? Does what you prioritise for fixed income vary compared to equities or private assets, or is it very much a similar theme?
Yeah, so completely agree. Fixed income is becoming increasingly important, and it's also good returns at the moment. As we're starting to develop our post-retirement investment strategies, fixed income, both in public markets but also private markets, we've got quite a high exposure to private credit already, is going to become an increasingly important part of how do we deliver sustainable lifelong incomes for our members beyond 65 all the way up to 85. So that's increasingly going to be one of the kind of key parts of our portfolio, what we'll be kind of throwing off dependable, secure incomes. At the same time, we're very, very keen to keep our members exposed to an element of risk well into retirement. If you've still got another 20 years that you need to invest for, then putting all of your money into fixed income, we think would be overly conservative. And it's also you're losing some of the kind of benefits of diversification. So fixed income is really, really important. Mixing between public and private markets is great. I still think people into their 60s and 70s should have some exposure to things like infrastructure assets as well as equity all the way through. And it's only right towards the end of somebody's savings career would we want to not have that exposure.
That's interesting. So we've talked about equities, we've talked about fixed income, private assets we've sort of touched on. Before we kind of get into the UK productive finance angle, is there things about private assets that you like from this fiduciary duty perspective? Does it make it easier, for example, to think about climate change? And I can think about that in two ways. First of all, you mentioned your wind farm off the shore of the UK. So you could think of that as a hedging against climate change because you're building the technology that's hopefully going to replace oil and gas. And is there a sort of like one of the aspects of private assets is that you can have more control, that it can be easier to exert more control on the board? Does that play into your decision making when you're thinking about your private asset allocation, that broader fiduciary duty point?
Yeah, I think that's a really good point. And I think kind of part of the challenge is of investing kind of broadly through kind of indexes is elements of your stewardship activities. It's challenging if you're trying to steward 500-600 companies. There's only so much resource you have. So whilst that's an extremely important part of our strategy, we tend to try and focus on those areas where we think there may be some concern, or those areas where we think we have most chance of influence. As we move increasingly into private markets, and private equity and infrastructure equity and private credit, it does mean that these will be smaller portfolios in terms of the number of stocks compared to our large developed equity portfolios. It means we have more control and more say in how these assets are run. At the moment, our model is everything is run through third-party fund managers, and we're looking to evolve our approach. So we'll move more into kind of co-investment opportunities as we go forward. But I think it brings the kind of fiduciary responsibility kind of more into it's less, well, this is what the market gave me, and more, how can we be shaping markets? How can we be involved in what are the key technologies of the future? I think that these are much more kind of interesting conversations we're having with our fund managers, and increasingly with the underlying assets the fund managers are investing in.
Okay, so let's then move to UK productive assets, because in that pensions expert article, it makes it clear that part of the reason for the legislative overhaul is to encourage pension schemes to invest in the UK. So what's Nest's approach to investing the domestic economy? I've talked a bit in the past on this podcast with Mark Fawcett about that. You mentioned the wind farms. So there are other areas that you're looking at where you think the most exciting opportunities are for our domestic economy.
Yeah, I think the bill's been very clear, and things like Mansion House and Sterling 20, which Nest are part of, that UK kind of pension funds should be looking for opportunities to invest in the UK. We think the UK is a great investment opportunity. The point we've made all along is that you wouldn't invest in the UK if you didn't think there was good investments to be had. And of course, it's a big economy, lots and lots of, in particular, infrastructure projects that are seeking more capital. So we see it as a great investment case, but then that can broader case of the additional impact that we can have for our members, many of whom are more vulnerable. This will be perhaps the first time they've saved for a pension. Nest may be the only pension they have alongside their state pension. So being able to generate decent returns for their retirement, but also to invest in the local economy, invest in kind of creating jobs, we think is incredibly powerful. We've started investing more in kind of UK residential buy-to-let housing. I think some of the other private market investments and big data centres really, really interesting. We have investments in solar farms in the UK as well. So there are loads and loads of opportunities. I think the challenge is the government is very, very keen for pension funds to invest more in big UK infrastructure projects. Are they setting up the right kind of pipelines? Are they kind of setting up investments in a way that make it attractive to pension schemes? I think this is an area that there's a lot of kind of fertile ground there for government and pension funds to come together and achieve common goals. So I think that the debate about fiduciary duty and making it absolutely clear why wouldn't trustees think about investing locally, I don't think that has any kind of detriment on fiduciary duty. You've still got to ask those questions: is this a reasonable investment? Do we think we're going to get reasonable risk and return? Have you done your due diligence properly? As long as all of those things are being done, why wouldn't you look more kind of closely at home for opportunities?
And we touched on this a bit before. I mentioned, where there was really interesting cusp of, up till now, DC has just helped people to build their wealth, and now you're going to help them to spend their wealth. So it's going to be a case of the Financial Times supplement, how to spend it in retirement. I'm being a bit flippant, but you're going to help people to and through retirement, with the UK government saying that they want simplified choices and they want a default retirement option. When it comes to that phase, we've sort of touched on it a bit, but that's a very different investment proposition, isn't it? It is and it isn't, to somebody just maximising the size of their pot over multiple decades. How are you thinking about the investment implications of that as people move through retirement? We touched a bit on fixed income, and you talked a bit about the importance of still being in growth assets, because it's still a very long time journey, a very long journey when you're in retirement. You've got to keep some way of accumulating, continue to grow that capital. How are you thinking about that? Is there new asset classes that need to come in to do that, or is it about adapting what you have?
Yeah, I think it's a bit of both. And when we think about kind of our membership and the numbers of people coming up to retirement, at the moment, not that many people over the age of 65 within our scheme. Not that many people have large pots. And by large pots, we're talking about pots of more than £10,000, not hundreds of thousands of pounds. That number is going to rapidly increase over the next 4 or 5 years. So the importance that people have solutions that work with their lives and expectations are increasingly important. So we're very, very supportive of the provisions in the bill about the importance of default strategies. I think the idea that people who have been automatically enrolled into a pension scheme have been told you don't have to make decisions about investing. All you need to focus on is, are you contributing enough and when do you want to retire? And then people getting to 65 or older or even younger, and then being told they then need to navigate an extraordinary complex market seems unrealistic and unfair. So the way we're thinking about this is, well, like many things, there's no single solution. So we don't think investing is the only way to solve this problem. We think it's a mixture of investing and insuring and getting those blends in the right quantity at the right time. Having said that, the vast majority of what drives returns will be how well people are invested for retirement. And the way we're thinking about this is almost a lot of our kind of investment beliefs for accumulation, you almost turn them on the head for decumulation. And in particular, the concern of sequencing risk. And in accumulation, if you've got 20 or 30 years, to a certain extent, you can ride out shorter-term market volatility. We're very, very concerned about what that means in retirement. So finding investment techniques, finding investment assets that manage some of that risk, where you could be withdrawing from your pot whilst at the same time markets are crashing around you, it is going to be a key part of our future proposition. And then the other piece to the jigsaw is having an element of insurance. So you're not trying to make a pot last for 30 or 40 or more than 30 years. So ensuring the risk of living longer than you expect, we think that makes a lot of sense, which is why we're in the process of procuring an insurance provider to provide bulk deferred annuities that are paid for at 75 and kick in at 85, but hold them as an asset of the scheme. So what a member sees is a regular, sustainable income, primarily invested, so possibility for that to increase over time, but also an extremist may have to be cut. So not a million miles away from decumulation CDC, which is a consultation the DUP have just brought out.
Yes, well, I'm glad you raised CDC, because that was going to be my next question. Is CDC the solution for the retirement income conundrum? I know what I think, but I'd love to hear what you think, Paul. We definitely think it's got a part to play. I think we're more interested in decumulation CDC, and we're particularly interested in decumulation CDC for helping with the mortality pooling element. So our approach is to use third-party insurers to pool mortality, but we could imagine that the CDC legislation could be particularly helpful if we decided to use a different approach in the future.
So I think our overall take is it's really, really important that trustees have lots of different ways of managing the risks of retirement for their savers. Not sure there's only one way of doing things. That would be the same as saying there's only one investment strategy that would work for all members. And what we see in the UK and around the world is all sorts of different approaches to investing being pretty successful. So I think we're happy with the idea of some plurality of ways in which people could access their money, and we're pretty clear what we want to do for our members, but fully open to that evolving over time to get the most efficient outcomes.
Yeah, well, I mean, CDC stands for Collective DC, and, I've always a bit tongue-in-cheek argued that master trusts are a form of collective DC, and you were the first out the traps back when Freedom and Choice was first announced to suggest this deferred annuity solution, and your deferred annuity solution got deferred until about now, and now you can start thinking about it. So I have my reservations about, the intergenerational impacts and whether we see similar with profits. So I think a collective solution, especially when it comes to managing mortality risk, which is so difficult to do on your own, and it's unrealistic to expect somebody who's been through a paternalistic system their entire life to then have to manage both their longevity risk and their investment risk as an individual, which is a bad idea, just as though a pot has reached maximum value. So I think there are definitely solutions there. But as the market gets bigger, and you talked about how pots are currently about £10,000 are going to get to £100,000, and another bit on the pension schemes bill is a government that's keen to sort of drive forward consolidation. As one of the largest master trusts currently in the UK, I think you have AUM of about 50 billion at the moment. Do you think about that consolidation bit higher than 50 billion? If you could tell me the exact number so we have it correct on the podcast. Yeah. Do you think about what you need to do? What happens when you reach 100 billion, for example? Obviously, you're well over the 25 billion that the government requires. There's no need for you to buy anybody or merge anybody, which would be a bit odd given your unique circumstances. But how are you thinking about the future? Because what I've learned about running a small business is you need to think about the future now. Otherwise, you get completely caught out by stuff as it arrives.
Yeah, it's really interesting, and I've been at Nest since inception, and the solutions for a scheme when you have a few million, or even if you've just got a few billion, from an investment perspective, are very, very different from when you get to 50 billion and as you move towards 100 billion. I think for us, what's been most instructive is looking at our kind of counterparts internationally. So if we look at the Canadian funds, they're huge, much bigger than any kind of UK pension schemes, and the same with the Australian super funds. So we've spent lots of time talking to colleagues both from Canada and Australia, and continental Europe, and the Dutch pension schemes are really helpful as well. A lot of the changes that we're going to be going through from an investment perspective is making sure we're properly structured to manage all of that extra money, and a big part of that is sort of moving along the sort of investment chain. So when we first started out, the only way we could invest and kind of fulfill our sort of investment beliefs about diversification were to use kind of pool funds, where we're very much kind of buying off the shelf and then mixing them internally. As we got larger, we could move to segregated mandates. As we get bigger again, we can move to private markets. And our kind of next stage of kind of development is moving more into the co-investment space, potential in the future that we may want to insource some elements of asset management. But to do that, the infrastructure that you need to have wrapped around your internal investment capability is much more complex, and you start looking more like a fund manager. So that's the sort of journey we're going on. We don't have a kind of specific destination. We've seen some very, very big pension schemes still primarily use external managers for their allocation. But what we do see is the ability to kind of monitor and hold managers to account, the ability to attract the right kinds of people to those organisations, organisations as they get larger, it just becomes harder if you want to keep improving. And our approach has been, as we've got bigger, why wouldn't we offer our members more sophistication if we can do that at a similar cost? So I think scale is a huge advantage. There may be some points in the future where scale can be kind of problematic in terms of you just get too big to do some things. We feel we're a long way away from that. And I think our big challenge is making sure that we have the infrastructure in place to manage 70 billion, 100 billion, and beyond.
So do you have any advice? Because a lot of schemes are going to either sort of like do or die really over the next sort of 5 years with this 2030 deadline for 25 billion. So you're going to see, I think we're going to see some master trusts merge. We're going to see some just try to grow organically. Have you got any lessons that you can share of how to manage that growth and that you haven't gone through consolidation, but that rapid growth and the growth in assets, and you are chief operating officer, the operational challenges of getting bigger very rapidly?
Yeah, I think. I wouldn't want to tell anybody how they should be running their scheme. I think my kind of learnings, I think, over the last 5 or 6 years, is that you're always a little bit behind, and you should always start much earlier, kind of planning for being larger and what that means. I think in some ways it's been quite challenging from 2010, certainly up to sort of COVID, that it was very easy in some ways. The markets were going up, and it looked quite straightforward to make kind of decent returns by just being heavily in equities and doing that in a fairly kind of cost efficient way. And I think that can lull you into a false sense of security, that how hard you actually need to work in order to deliver good risk-adjusted returns. So I think my advice would be, as you get bigger, you should start kind of planning a lot sooner and start getting things in place in order to meet those challenges. Don't be sort of lulled into a false sense of security because returns have been good and because markets have been fairly benign, which they were, I think, for the first kind of 10 years of our sort of investment lives.
Yeah, I mean, that is what is sort of the universal investor concern, isn't there, at the moment? You know, how are we actually going to make enough return in order to keep everybody happy and to grow wealth at the rate that we need to? That's a generalised global investment concern, isn't it? Yeah,
absolutely. And then it's more complex. I think it's a more complex investment environment now than at any time since we started. And looking for kind of alternative sources of growth, not just relying on kind of US tech companies to keep kind of growing in the way that they have done since 2010. Thinking about the kind of geopolitical challenges that are much more challenging, I think, than the environment in when we first started investing in 2010. All of these, it's harder, it's more complex. You need to have a lot more kind of focus on your risk and your due diligence and your operational capability than ever before. And I think for DC and Master Trust to continue to be a success, I think the sort of next 5-10 years is going to be. I mean, we've done a great job of getting people saving. We've done a great job at the kind of the starting approach to investing. I think across the industry, automatic enrolment has been phenomenally successful. How we do the next bit, which is continuing to grow in a more challenging investment environment, but then the bit that nobody's really cracked anywhere internationally from a DC perspective, and the way you can then turn those pots into lifelong incomes where people don't have to make really complex choices either at the beginning or all the way through. That feels like a really big prize over the next 5 years.
Great. That's a fantastic place for us to end this discussion. Run a little longer than we usually do, but it seems only fitting for the last episode of Series 4 of the Professional Investment Podcast, and with such an illustrious guest. I just want to say thank you, Paul, for all of those insights. It's been great chatting to you. I've really enjoyed it. I hope you've had a good time too. Listeners, if you want to make sure that you never miss an episode of the Professional Investment Podcast, Series 5 will start again in January. Make sure you hit the subscribe button. And if you're listening on Spotify, do engage with our Paul. Thank you for listening, and thanks for being on the show, Paul.
Thanks very much, Charlotte.